Welcome to this explainer. Today, we're doing something really cool. We're going to track the exact same $50,000 investment over a 20-year period to finally, once and for all, settle the massive debate, real estate versus index funds. We're bypassing all that internet hype and looking strictly at the numbers to see which path actually builds more wealth. And honestly, more importantly, we're going to look at what each of those paths physically demands of your life. Okay, let's dive right into this. If two people invest 50 grand today, who is actually richer in 20 years? We see this debated literally everywhere, at barbecues, on YouTube, you name it. Everyone is so absolutely convinced their chosen path is the undisputed champion. But to really figure this out, we have to strip away the hustle culture, look at two identical starting points, and let the cold, hard math do the talking. To do that, let me introduce you to Jake and Marcus. Picture two guys in their 20s, identical salaries of $55,000 a year, living in the exact same city, and they both managed to save up 50 grand. But they have completely different philosophies on wealth. Jake takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property. He locks in a 30-year, 7% mortgage. Marcus? Well, he drops his entire $50,000 into a total stock market index fund, and he sets up a simple, boring, automatic contribution of $300 a month.
Now, on day one, Jake is feeling like an absolute financial genius. Based on that napkin math that gets everybody so hyped up about real estate, he finds a tenant willing to pay $1,800 a month. His mortgage payment is about $1,330, so on paper, his rental property yields him a really impressive $470 a month in pure profit. Well, before a single dollar is spent on anything else, that is.
The immediate day one experience for these two guys couldn't be more different. Jake gets to physically drive by his asset, right? He collects tangible rent checks, and he gets to brag at dinner parties with some incredible social proof. Marcus? Well, Marcus gets an invisible confirmation email on a screen. When his friends ask what he's investing in, he says index funds, and yeah, the conversation kind of just moves on.
But, as you probably know, feelings and math are two very different things. We're going to track their progress through a chronological 20-year timeline to reveal the massive difference between how money feels and how money actually behaves over the long haul.
Fast forward to year 3, and wow, the illusion of Jake's cash flow completely shatters. His gross rent is absolutely obliterated by real-world property expenses. Over those 3 years, sure, he's collected an incredible $16,920 in gross cash flow. But wait, you've got to subtract $3,000 a year for property taxes, $1,500 for insurance, a $1,200 water heater, a $2,800 roof leak, and oh yeah, a month of vacancy. Suddenly, Jake's actual net cash flow over 3 years is hovering right around a mere $2,000. Ouch.
However, Jake still has a major secret weapon that Marcus just doesn't have, and that is leverage. Basically, his $50,000 is controlling a $250,000 asset that is steadily building equity in the background. Even with all those crazy expenses, the property is appreciating, and his tenant is slowly paying down that massive mortgage for him. This is a super powerful advantage that stock investors simply cannot easily replicate.
But listen, that leverage comes heavily burdened by the invisible costs of landlording. It totally transforms his investment into a stressful, part-time job that he honestly isn't getting paid for. I mean, think about it. Properties sit empty on average 1 month a year. Maintenance generally eats up 1 to 2% of the property's value annually. And if you decide to hire a property manager to handle the headaches, bam, that's 8 to 10% of your rent completely gone. And if you manage it yourself, well, you're trading your weekends and evenings for those returns.
Meanwhile, let's look at Marcus at year 7. His completely hands-off portfolio has quietly compounded to as much as $150,000. And he did it with absolutely zero phone calls or weekend plumbing repairs. He didn't pick individual stocks, he didn't try to time the market, he literally just didn't touch it and just kept making those boring $300 monthly contributions.
And this brilliantly illustrates the whole shape of their wealth. Jake is grinding away for linear growth. His wealth is definitely growing, but it grows slowly after taking out all those expenses, and it demands his constant, undivided attention. Marcus, on the other hand, is effortlessly riding this astonishing compound curve. For the first few years, his growth was totally boring. But now, the gains on his gains are generating more new wealth than his original contributions. Let's pause at the 10-year mark. This is wild. Their net worth is shockingly close. Jake's equity sits at around $170,000 to $184,000. Marcus is right there at $165,000 to $180,000. But you really have to look closer at the hidden costs here. Jake has sunk hundreds of hours and an extra $20,000 to $35,000 straight out of pocket into his property. Marcus purely benefited from compounding while spending exactly 0 hours of his time. So that brings us to the crucial point, right here at year 20. This is the grand twist of our explainer. They both, surprisingly, ended up with roughly $450,000 in net worth. After 2 decades, Jake's property value has basically doubled, and his mortgage is nearly paid off. Marcus's portfolio, fueled by the stock market's historical average 10% return, has absolutely exploded. Mathematically, they're in the exact same ballpark.
They arrived at the exact same financial destination, but the toll they paid along the way was night and day. Jake paid the toll in literal sweat. He took on hundreds of thousands in debt, endured years of stress, and concentrated his wealth in one single asset in one specific zip code. Marcus paid his toll by enduring brutal market volatility, but in exchange, he gained complete liquidity, diversification across thousands of companies, and absolute freedom of his time.
But what happens if we tweak just one tiny variable? Let's say Marcus adds just $200 more a month, bringing his contribution to $500. His wealth multiplies dramatically, jumping to a massive $550,000 to $600,000. You see, in the stock market, increasing your contribution has this effortless multiplied effect. For Jake to increase his real estate investment, he usually has to go out, buy a whole new property, take on a second mortgage, and completely double his physical workload. Now, to be completely fair here, stock market influencers absolutely love to gloss over the brutal reality of volatility. Massive drops can gut-wrenchingly erase tens of thousands of dollars in mere weeks. I mean, in 2008, the market dropped roughly 37%. In March 2020, 34% just vanished in a single month. Watching your portfolio drop from $150,000 to $95,000 isn't just some number on a screen, it is terrifying. And sadly, many retail investors panic sell, locking in those massive losses permanently.
Furthermore, let's be real, stocks offer virtually zero cash flow today. Unlike a rental property that can eventually pay your living expenses outright, typical index fund dividends yield a meager 1.5% to 2%. On a $150,000 portfolio, that's only a couple $100 a month. That absolutely will not replace your day job's income if you're looking to retire early.
So, based on the source data, let's be super clear. Real estate undeniably wins in specific, identifiable situations. If you find a property with a strong 0.8 to 1% rent-to-price ratio, the cash flow math tilts heavily in your favor. Or if you use a strategy like house hacking, living in one unit while renting out the others, you can essentially eliminate your own rent entirely while building massive equity. The stock market simply cannot put a roof over your head for free.
On top of that, real estate creates more millionaires largely because of unparalleled, totally legal tax shelters. Have you heard of depreciation? It basically allows you to deduct the theoretical decline of your building's value from your taxes, even if the property is actually going up in value in the real world. And 1031 exchanges? They let you roll your profits into bigger properties completely tax-free. These are massive, powerful tools that regular stock investors just can't access outside of their retirement accounts.
So ultimately, the real trap here, it isn't actually choosing between real estate or stocks. The real trap is blindly picking an investment path based on some flashy YouTube headline or what your buddy said at a barbecue, without doing the hard math on what it will actually cost your lifestyle. Jake thought real estate was a proven given. Marcus thought stocks would just do all the work. Neither of them fully mapped out the invisible costs over 2 whole decades.
So, looking at all of this, which path actually aligns with your true goals and the amount of free time you genuinely want to have? The next time someone guarantees you that one path always wins, ask him this: did you actually include everything? And honestly, it leaves us with one final fascinating question to ponder. Are you brave enough to run the real math on what happens when you decide to conquer both?